So our next presenter, he probably doesn't really need an introduction either, because I think that I've been to more of my conferences than anybody, but Corey's probably been like second. And I keep asking him to come back, and he graciously keeps coming. And part of the reason is that I just have always believed, first of all, I know the stock sometimes has these moments where, you know, people are like, why doesn't the stock move? And I don't know the answer to that, but I always have kind of suspected that some of it has to do with the fact that they pay this great dividend, which you don't see small companies do very often. So it kind of creates a strange mix of investors, I think. But I think Corey will support this view that the company's in the midst of a new leg up in production. They're adding that, and I think the stock is still remains cheap without the new leg of production. I think that new leg of production is going to drive better valuations. I think it's going to drive better dividends. And I followed this for a long time, but I'm going to keep beating the drum until it gets to that place where either I can't beat it anymore, or it sort of trades ripple along. So.
All right, thanks Dave, thanks for the introduction, and good to see everyone again. A lot of familiar faces. It's always good to be in Denver. So a lot of you already know the Alvopetro story, but for those of you that don't, on July 5th of 2020, Alvopetro became the very first independent company in Brazil to deliver sales specified gas into the local distribution network in the state of Bahia. You can see where we're operating there in the northeast part of the country. I think since then we've been delivering very strong results, certainly well ahead of the expectations that we would have set within this room the very first time that we were here. We benefit from some very high natural gas pricing, very strong operating margins and operating netbacks. That helps us generate very strong free cash flows. And that all together helps support this more balanced and disciplined capital allocation model that we have, where we're looking to take half of our cash flows and reinvest that in organic growth, and take the other half and return it to stakeholders. Our capital program is all organically funded, and you'll see it's looking to unlock a tremendous amount of additional value for our shareholders. You'll see the assets that we put in place in Brazil. We've got some highly strategic infrastructure now that really uniquely positions us to really rapidly convert successes into production and cash flow. And then lastly, last year we actually added a second growth platform in the Western Canadian Sedimentary Basin in the western part of the province of Saskatchewan, and I'll show you what that looks like, but we can now invest in high rate of return opportunities in two locations. So our pitch has always really been a value yield and growth pitch. Like I said, I think we've got a pretty strong track record of delivering strong financial and operational results. We've got exceptional free cash flow generation capacity, a strong balance sheet, and all that helps drive that balanced capital allocation model that I talked about. The chart on the top right there just highlights our current enterprise value in the black dash line, so about $230 million, and compares it to our 1P and 2P reserves, so that's proved or proved plus probable reserves. And the green was the initial project that we talked about when we first started coming to Denver, and the orange is the latest project called Murucututu that I'll talk a little bit about, because that's a big driver of our growth going forward. You can see the stacking bars there. If you include the additional resource potential that we see on those lands, we're targeting a total value approaching $900 million. So from a growth perspective, a lot of potential, especially relative to our existing enterprise value. And then on top of that, I'll show you the more extensive inventory of Canadian drilling opportunities that we've added more recently. And then from a yield perspective, on the bottom right, you can see we introduced the dividend back in the third quarter of 2021. Most recently, we paid dividends quarterly in US dollars. In Q1, we declared declared a dividend of 12 cents US per share, so that's a yield of over 7%. And in total, we paid out almost $2 US per share of dividends since we started that program. So on the production side, Dave alluded to this a little bit. If you recall, for those of you who've been with us for a while, we did do an upgrade to our gas sales agreement at the beginning of last year, and that helped us increase that along with the strength of some results from that Murucututu project, helped really set the stage for a pretty exceptional year for us in 2025. Our production was up over 40% year over year. And you can see that we've started off 2026 even stronger. We had record quarterly production in the first quarter of over 3,100 barrels of oil equivalent per day. So that's up another 25% over the prior year's increase. And we just announced April sales about 5 minutes ago. And you can see we're continuing production at about these levels. So I think if you consider this growth that we've been able to generate in the context of us paying out half of our cash flows in stakeholder returns, this is pretty remarkable, I think, and I don't think there's any of our peers that are generating these types of results and payouts. So one of the reasons we can do this is our production is extremely valuable. So this is just the measure of per unit of production profitability called operating netback. So what you can see on the top of the bars, that's the realized price that we receive for our commodity. In 2025, you can see that was close to $63 per barrel of oil equivalent. It was a gas price of over $10 US per MCF. We've got pretty low royalties. We've got a great fiscal regime in Brazil, so our royalty rate was only about 7%, and that's the orange bar that you see there. And then we've got low cost natural gas production, so very low operating costs, under $6 per barrel of oil equivalent. And the net effect is the green, that's the profit we make per unit of production, almost $53 per BOE. And then if you take that green bar and divide it by the height of the top of it, that's our operating netback margin, about 84%, which is about as good as it gets in our industry. And then if on top of that you consider the fact that our project in Brazil qualifies for an enhanced income tax regime where we only pay 15% tax, and we're not taxable in Canada with our tax pools, it gets even better on a relative basis. Last point, we do report our Q1 results on Thursday, so you don't see, that's why you only see 2025 on this slide. So this graph just highlights that more disciplined capital allocation model that we are following, taking about half of our cash flows and reinvesting it in growth and the other half in returns to stakeholders. The cash inflows each quarter are the green lines with the black dots that you see there, and the cash outflows each quarter are the stacking bars. So the yellow shade is where we've invested in growth, and the various shades of green are the various shades of stakeholder returns. I'll draw your attention to the pie on the top right. That just shows since our project came on production, we've generated funds flow from operations exceeding $200 million US now, and about 52% of that's been reinvested, and 48% of it's been returned to stakeholders. So pretty close to that 50-50 model that we'd set. And like I said earlier, we paid out dividends of almost $2 US per share now, over $70 million back to shareholders. So just a little bit about our main operating base here in the state of Bahia, the Recôncavo Basin. This is the oldest producing basin in Brazil. Pretty well-developed area. There's extensive highways, power going through here. You can see all the pipeline infrastructure on the map. The main city of Salvador is at the very southern end of that map. It's actually kind of off the map. You can see it in the picture here. The key thing is as you drive north out of the city, you go through this major industrial complex called Camaçari. And our operating area just sits about 15 to 20 kilometers. Sorry to use kilometers, I am from Canada. Sorry about that. Our initial project Cabaret was those green wedges that I showed you on that stacking chart at the beginning of the presentation. And then our main growth asset is called Murucututu, and it sits immediately north of that. So the nice thing is all of this is already pipeline connected into a gas plant that we constructed. It then goes directly into the local distribution network thanks to our main customer here, Bahia Gas. They built all this infrastructure to deliver that right into this industrial demand center. We don't have to access any of this national pipeline infrastructure that you see here. And the net effect is we make a lot more money per unit of production than any of our peers in the area. The last thing just about Brazil is, it's pretty well known to be a big oil exporter and a big oil producer, but what's underappreciated is Brazil's actually importing natural gas, and the state of Bahia is actually consuming more gas than what's being produced in the basin here. So we're in a really good position with this highly strategic infrastructure that's right connected into the distribution network. So just talk about our gas sales agreements, or this is how, the price under which we sell our gas. We did upgrade this again at the beginning of this year to further expand our firm sales by another 25%. So right now we're pricing off two different formulas. This QDC1 is the original contract that we had. It's the red line that you see on the top here. And then we have added this QDC2, which is the orange line. 80% of our gas is being priced under this red line, and you can see by the formula, there's a fixed component that gets indexed to inflation, and then the variable component is partly Brent oil-based, and then partly Henry Hub natural gas at a premium plus another fixed premium on that to translate into the realized price. And then the new contract, about 20% of the volumes are being priced just on a Brent only basis. So what you see here is using the forward price curve as of April 30th, you can see the projected natural gas prices on a blended basis is the green line. And you can see a big uptick that we've got here. The price gets reset every quarter. So on May 1st, our price is adjusted based on the commodity prices in the first quarter of 2026. And then you'll see in August, you see another big bump up, and that's because of the pricing that we're seeing here in the second quarter of 2026. So the May 1st reset to over $11 US per MCF, and the August one based on current futures prices is forecast to be over $13 US per MCF. So when you combine that with the production increase that we saw earlier in the presentation, I think we're slated to have some pretty significant increases in cash flow as we move through the year, which Dave alluded to. So, just real quickly on the growth plan for 2026 in particular, a lot of it's to focus on this asset to the north of Cameron called Murucututu. We had some extremely strong results there over the last couple of years with two wells. One's called 183A3. And then last year we drilled the 183D4 well, which I'll show you on a coming slide. But that well basically, exceeded pre-drill expectations by probably about double. So a lot of the success we're having and a lot of the success I think we'll have going forward relates to that asset. One of the challenges is when you have a result that's way better than what you'd originally expected. A big part of our capital program this year is to really attack that higher than anticipated results. So a big chunk of our capital for this year is actually very low risk facilities based type capital. So we're going to expand this gas plant that you see here and enhance it so that we can take a bigger and bigger percentage of this hotter or richer gas from Murucututu. And then we're also going to expand, I'll show you what this looks like, where we're going to expand the field production facilities and the pipeline takeaway from Murucututu by about 4 times. And then in parallel, we'll be drilling the development wells to follow up on those earlier successes. So we've got a big chunk of reserves and contingent and prospective resource assigned to this asset. As you saw in that initial stacking chart that I showed at the beginning of the presentation. And our goal is to migrate that into production and cash flow on a multi-year basis. This is maybe a bit too much geoscience, but I'll try it anyway. So this is the main bounding fault that traps all the hydrocarbons at the Cabaret field, and it also traps the hydrocarbons deeper in the basin for the Murucututu asset. So this is some 3D seismic that we have covering the area. The two wells that I talked about were 183A3 and then the 183D4 well. And then you can see by these contours, just like if you were hiking in the mountains over here, you go up structure, so higher and higher and higher as you go towards the fault. You can see that in a picture over here. So the reservoir is climbing, and you've got a big portion of the reservoir that's still undeveloped, which is this whole southern portion of the Murucututu field. That's what we'll be targeting over the next couple of years. And then in addition to that, just outside this kind of seismic character here, one of the prospective area that our reserve evaluators have assigned can be targeted from this 197-1 well that you see here. So we've got another big area of potential growth with success in that fairway. Just from a Google Earth perspective, this shows one of the drilling pads. This is the 183 lease, so this is where our field production facility for Murucututu sits. We've got a couple wells drilled here, and then there's another drilling pad further to the south where we drilled the 183D4 well, and where we're currently drilling the 183D1 well. So that's the next development well in the program. Like I said, we're going to expand this facility fourfold, and we're going to increase the pipeline capacity or the egress coming out of this field by 4 times, and we expect to have that all in place by the end of this year. On a longer term basis, so I just talked about the near term, we're going to focus on the following up on the Karasu success we had in the 183D4 and A3 wells, and then longer term, targeting the Gomo formation, which is a deeper formation in the northern part of the block. We can drill off of centrally located drilling pads to minimize our footprint and drill directional wells and tie all that back into the same facility that's all pipeline connected back to the sales point and our gas plant that you see right here. So the nice thing is, our early investments at Cabaret, really underpinned all these facilities investments, and now we're really reaping the benefits of those earlier investments. So moving on from Brazil, I think February 5th of last year, we announced our re-entry into the Western Canadian Sedimentary Basin, and then we expanded that agreement midway through the year. We've now got a 50, so we're targeting what's called the Manville Stack Heavy Oil play fairway, and our AMI covers the entire Saskatchewan side of the play fairway. So we've now got a 50% interest in over 110 sections of land, over 32,000 net acres. And what we're doing here is we're drilling open hole multilateral wells. This is a leading drilling technology to unlock these previously, these are very low geological risk reservoirs. They've been known to be there for quite some time. They're 3 to 5 meters thick. Our reserve evaluator, based on the few wells that we drilled last year, did assign some 2P reserves, but only had 8 undeveloped locations assigned as of the end of the year. And you can see, based on the inventory of land, we think we've got over 100 Tier 1 drilling locations that we can drill over the coming years. Show you what that looks like. This is GLJ's estimation of so what we've done with the program that we did last year is we earned all this acreage, but we also delineated 3 kind of core areas for ourselves. These are the production curves that our independent reserve evaluator GLJ has assigned to those 3 areas. You can see the wells, forecast to come on production between 110 and 150 barrels of oil per day, and then over the life of the well, cumulatively produce between 100,000 and close to 180,000 barrels of oil. So even at a $70 WTI forecast, you know, that's, you can generate between 50 and over 100% rates of return by drilling those types of wells. And we've got nice exposure to oil prices with this asset. And you can see we've got a much bigger inventory of opportunities that we certainly see that sits on top of that kind of stacking growth chart that I showed at the beginning of the presentation. So pretty happy, and we're just getting going here. So just to conclude again, it really is a yield, value and growth story. Like I said, 2025 really was a transformational year for Alvopetro. We continue to deliver some pretty strong results. Obviously, very high natural gas prices. Those prices that you saw there, you know, we're going to be up close to $13 per MCF. If you compare that to the U.S. Henry Hub pricing, it's about $2.60 per MCF. In Canada, it's even worse. It's, you know, about $1.50 Canadian per MCF. So these are, it's a pretty nice place to be producing natural gas. Helps us generate industry-leading operating netback margins and those strong free cash flows that I talked about. Year over year, our production was up 41%, but our reserves were also up 43% after producing close to 1 million barrels of oil equivalent last year. So we replaced production more than 5 times with our reserve replacement this past year, which is exceptional. For value investors, you know, we're trading at you know, less than 60% of our 2P net asset value. For yield investors, that 12-cent US per quarter dividend represents a 7.6% yield at today's closing price. And for growth investors, hopefully you'll see, I think we've got a lot of exciting investments ahead of us, and we can unlock an awful lot of potential, especially relative to our current enterprise value. So, you know, I guess the last point I'll make is, you know, we did increase production last year 41%. If we continue this year's rate that we're at, that's another 25% increase this year. And with those facilities investments that I'm talking about and the next development drilling campaign, we'll be well positioned to deliver at least another 20% in 2027. So that'd be 3 pretty exceptional years in a row, especially when you consider it in light of paying out half of our cash flows in stakeholder returns. So we're pretty proud of this and look forward to coming back for many more years.
Questions?
So you went through the revenue increases and the contractual aspects of that, whatever. So what are the expenses?
Yeah, so the biggest expense in our industry is capital expenditures. But from a profitability perspective, I tried to show that in that stacking chart. So the operating netback chart. So the orange pieces, about 7% of our realized revenue goes to royalties, and then about $6 per barrel of oil equivalent is operating costs to produce the production.
Maybe I didn't ask the question correctly. So in other aspects of mining, some of the miners are finding that they're going, hey, revenues went up 50%, when their expenses went up 70%. Everyone in the food chain is increasing the prices at a faster rate.
Right.
So that's really what I'm trying to get. What kind of revenue leverage are you getting, if you're even getting it, based on what the expenses?
Yeah, so the nice thing is let me touch on the capital part second. On the revenue and down to operating income, those are the only costs. So we have 84% operating netback margins. There are taxes, but they're at 15%, and I think our taxes last quarter were under $1 million. Like, it's very, very low because we can shelter it with all of our capital investments. The best way to capture what it costs us to find, so the other valid question is, okay, what does it cost you to find new barrels? I think that might be what you're probably at. And that number is roughly, you know, $15 or less. So if you compare that to our operating margins at over $60, then what that means is you get payout on that investment over 4 times, which is exceptional. Like, anything over 2 in our industry is pretty good. Over 3 is exceptional. That's probably the best way to answer that. Yes,
Can
sir.
you say how many wells you think you'll develop in Canada this year? Is it something like 1 or 2 a quarter? Is that kind of where you're at? That seems like
Yeah, so we did 2 programs of 4 at a time, and I'm expecting, this summer, we're just working that out with our partner, but I'm expecting probably another 4-well program sometime this summer.
Great. Oh, I do have one. I do have to make full disclosure. Everybody here knows. I think most people know me. I don't typically own the stocks that I write, and it's because I learned a long time ago that the SEC doesn't like it, and I don't. It's not someplace I want to go. So I have this hard, fast rule about that. But I have to admit, I bought the stock, some number of months ago because it was just to the point. It's like I've already got this almost as high a rating as I can on the stock, and I got so frustrated I just went, I just can't take it anymore. So that's my full disclosure. That's not a reason. But by the way, me owning it's not a reason to go buy it. But I don't think there's a lot left to go here. I mean, I just feel like, I guess if you think oil's going to $20, I just don't see how the story doesn't get better. So there you go.
One last comment. There was talk of a $4 million financing earlier, and I was joking, not joking, I was talking to Matt. Back in, was it October of 2018, I think, we did also, with the help of these gentlemen right over here, a $4 million financing, mostly to people that are sitting in this room today. So that equivalent price was at about $1. So we've returned almost double that in dividends now, and the stock's $6 or something. So you guys can buy me a beer.
Thanks, Corey.